Greetings, dear viewers. Welcome to the House Lux Estate channel. This is your go-to hub for all things real estate investment. Here at House Lux, our mission is to empower you with knowledge, providing you with up-to-date, insightful content that aids you in making informed investment decisions. Our purpose: to guide you through the intricate world of real estate, breaking down complex concepts into digestible, accessible information. We strive to shine a light on the potential that real estate holds, revealing the paths that could lead you to your financial goals. We focus on a wide range of topics, from understanding market trends to exploring innovative investment strategies. Today, we're peeling back the layers of a fundamental concept in investment strategy: diversification. Diversification, a key tool in managing risk within your portfolio, is something every investor should understand. Stay tuned for today's topic. We're delving into the importance of diversification in managing risk. Diversification, a term often thrown around in investment circles, but what does it truly mean? Well, in the simplest terms, diversification is the practice of spreading your investments around. It's like having an assortment of different fruits in your basket instead of just one kind. You wouldn't want to fill your basket with only apples, would you? What if there's a sudden glut in the apple market and prices drop drastically? You'd be left with a basket full of fruits that have lost their value. But if you have a variety of fruits, say apples, oranges, and bananas, you're less likely to suffer a significant loss because the prices of these fruits don't all move in the same direction at the same time. That, in essence, is the principle of diversification. It's about not putting all your eggs in one basket. It's about spreading your investment across different types of assets like stocks, bonds, real estate, and others, so that a decline in one category won't wipe out your entire portfolio. Let's take a more detailed look. Suppose you invest all your money in the stock of a single company. If that company does well, fantastic, your investment grows. But if that company hits a rough patch, your investment could plummet. However, if you spread your investments across different companies, sectors, and even geographical regions, you can cushion the blow. If one company or sector struggles, others may be doing well, balancing out your overall returns. And it's not just about protecting against losses. Diversification can also help you capture gains. Different assets often perform well at different times. Having a mix of investments could provide you with a steady income, even in uncertain market conditions. Diversification, however, is not a one-size-fits-all strategy. It should be tailored to your specific financial goals, risk tolerance, and investment horizon. It requires careful planning, ongoing monitoring, and periodic adjustments. Diversification is not just about having different investments, it's about reducing risk. And as any seasoned investor will tell you, managing risk is a critical part of achieving long-term investment success. Now that we understand diversification, let's discuss how it plays a role in managing risk. Diversification, as you might recall, is the strategy of spreading investments across various assets or asset classes to mitigate risk. You see, not all assets perform equally at all times. Some may excel in certain economic conditions, while others may falter. By diversifying your investments, you're essentially not putting all your eggs in one basket. Think of it as a safety net. If one of your investments takes a nosedive, you won't lose everything. Instead, the losses from one investment can potentially be offset by gains from another. This way, diversification can help reduce the overall risk of your investment portfolio. Now, let's delve a bit deeper. One way to diversify is by spreading investments across different sectors. Each sector of the economy, be it technology, healthcare, or energy, has its own set of opportunities and challenges. By investing in a mix of sectors, you can take advantage of the growth in one sector to balance out potential losses in another. Another way to diversify is through asset classes. These are groups of assets that behave similarly in the market but are distinct in some ways. Common asset classes include stocks, bonds, and real estate. Each asset class has its own risk and return characteristics. By diversifying across different asset classes, you can further spread your risk. However, it's important to note that diversification is not a one-size-fits-all strategy. The right mix of investments can vary depending on your financial goals, risk tolerance, and investment timeline. It's always wise to seek guidance from a financial advisor or do your own thorough research. And here's a crucial point to remember. The goal of diversification is not necessarily to boost performance. It's to manage risk. After all, investing is not just about making money. It's also about preserving your wealth and ensuring that you can weather the market's ups and downs. Remember, the goal of diversification is not necessarily to boost performance, it's to manage risk. How does diversification apply to the world of real estate investment? Well, just like in other investment sectors, diversification in real estate is all about spreading your eggs across multiple baskets. It's about not tying your fortunes to a single property, location, or investment strategy. Imagine, for instance, if you were to invest solely in commercial properties. Sounds like a good plan, right? But then, a global pandemic hits, businesses close down, and suddenly your income stream dries up. And just like that, you're left in a precarious financial situation. But if you had invested in a mix of commercial, residential, and rental properties, you could have cushioned the blow. Now, let's talk about geographical diversification. This is essentially about investing in properties in different locations. Let's say you've invested all your money in properties in a single city, and then that city experiences an economic downturn. Your investment could take a significant hit. But if your investments are spread across various cities or even countries, you're less likely to feel the pinch. And then there's the matter of varying your investment strategies. This could mean mixing traditional real estate investments with real estate investment trusts, or REITs, or it could mean balancing between long-term buy and hold strategies and short-term fix and flip strategies. Each method has its own risks and rewards, and using a variety of strategies can help balance out those risks. But remember, diversification is not about chasing every opportunity that comes your way. It's about thoughtful and strategic decision-making. It's about understanding the markets, conducting thorough research, and making informed choices. It's about balancing your portfolio to withstand market fluctuations. So how does diversification apply to the world of real estate investment? It's about not putting all your trust in one property, one location, or one strategy. It's about spreading your risk to increase your chances of success. Diversification in real estate is about balancing the portfolio to withstand market fluctuations. It's about being smart, being strategic, and being prepared for whatever comes your way. As we wrap up, let's summarize the key points we've discussed today. We've explored the importance of diversification in managing risk, a concept that's as crucial as it is compelling. At its core, diversification is all about not putting all your eggs in one basket. It's a strategy that can help investors weather the storms of financial uncertainty and come out on top. Think of diversification as the shock absorbers in a vehicle. Just as shock absorbers cushion the ride over rough terrain, a diversified portfolio can help smooth out the bumps in your investment journey. It can provide a level of protection against the unpredictable nature of markets, helping to mitigate potential losses. We've also highlighted how diversification can lead to a balanced and resilient portfolio. This is a portfolio that can stand the test of time, capable of withstanding market volatility and delivering consistent returns. A balanced portfolio is like a well-tuned orchestra, where each instrument plays its part to create a harmonious performance. Similarly, a diversified portfolio consists of various asset classes that work together to achieve your financial goals. Moreover, diversification is not a one-size-fits-all strategy. It requires careful planning and consideration of your individual risk tolerance, investment goals, and time horizon. It's about creating a unique blend of investments that aligns with your personal circumstances and aspirations. Remember, diversification is not about chasing the highest returns or trying to time the market. It's about reducing risk and increasing the probability of achieving your long-term investment goals. It's a strategy that focuses on the big picture, rather than getting caught up in the daily fluctuations of the market. In the realm of real estate investment, diversification can be achieved by investing in various types of properties, in different geographic locations, and across multiple sectors. This can help spread risk and enhance potential returns, providing a robust framework for sustainable wealth creation. Diversification is an essential tool in your investment toolkit. It's not about predicting the future, it's about being prepared for it. That concludes our discussion on the importance of diversification in managing risk. It's now up to you to take this knowledge and apply it to your investment decisions. Like a well-balanced diet, a balanced portfolio can help you weather the storms of market volatility. Remember, diversification isn't simply about owning different assets. It's about understanding how these assets work together to spread risk and enhance potential returns. Just as a master chef uses a variety of ingredients to create a culinary masterpiece, you too can use a variety of investments to create a robust and resilient financial future. Now, if you found this content valuable, don't keep it to yourself. Like it, share it with your fellow investors, and if you haven't already, do subscribe to the House Lux Estate channel. We consistently bring you insightful content that helps you navigate the world of investments more confidently. Thank you for tuning in. And remember, a diversified portfolio is a resilient portfolio. Until next time, keep investing wisely.